This video is brought to you by Seeking Alpha. Take advantage of Seeking Alpha's Black Friday sale, where by using my referral code, you can score a massive $90 off an annual premium subscription. Links in the description and the pinned comment. What are the smartest investors in the world buying and selling right now? That's exactly what we're diving into in this video. So last quarter's 13F filings have just been released, giving us a sneak peek into the strategies of some of the world's biggest names in investing: Warren Buffett, Bill Ackman, Michael Burry, Mohnish Pabrai, and more. And while some of these moves were somewhat expected, a few might surprise you. So like I did last quarter, instead of simply listing the top stocks that everyone bought, I've identified 5 key themes from the filings that could reveal whether smart money sees opportunity and risk heading into 2025. And yes, stick around to the end, as we'll most certainly be discussing the big one by Mr. Warren Buffett himself. So with that said, let's get into it and break down what the world's best investors are currently betting on. So starting with theme number 1, and this is actually a follow-up from the video I made 3 months ago, and that is that Bill Ackman is indeed doubling down and buying more Nike shares. Ackman, who manages Pershing Square Capital, is no stranger to making very high conviction bets, and this seems to be no exception. After initiating a position in Nike at the end of Q2 2024, with the stock falling about 20% on earnings, Ackman bought roughly 3 million shares, but in the most recent quarter, he added a whopping 435% or 13.2 million shares, bringing his total stake to 1.4 billion. That's a pretty big vote of confidence in the iconic sportswear giant, especially considering the challenges that it's currently facing. It's no secret that consumer spending is tightening worldwide, particularly in key markets like China, where economic uncertainty has impacted their sales. The company's latest earnings report in late September disappointed investors, with Nike reporting a 10% decline in quarterly sales, withdrawing their 2025 guidance, and postponing their first investor day in 7 years. And as a result of all this happening over the past few quarters, the stock has tumbled, as I said before, shedding about 20% of its value since the middle of the year. So what does Ackman see in this company that's been struggling to regain its footing? Well, for one, Nike is actively repositioning its business by focusing on its direct-to-consumer strategy. So it's moving away from its reliance on wholesale. So some turbulence is definitely expected. And while this transition hasn't been easy and has drawn criticism from some shareholders, Ackman clearly seems to believe that this strategy will pay off in the long run. Nike's management has been clear that they're playing the long game with this approach, aiming for a more balanced and profitable portfolio that can sustain growth for years to come. They're just not quite there right now. So for some, this one is definitely too murky to take a position in, but it is worth remembering that Bill Ackman is no stranger to making big bets during times of uncertainty. You only have to remember back to 2020, when he famously turned a $27 million hedge into a $2.6 billion windfall by predicting the pandemic-driven market crash. So long story short, Bill Ackman most certainly is buying the dip, and time will tell if that's a bet that will pay off. But with that said, let's move on to theme number 2 of the 13Fs this time around. And this one has to do with the Chinese tech stocks, because both Howard Marks and Michael Burry have doubled down on the thesis. Michael Burry, best known of course for predicting the 2008 financial crisis, increased his holdings in Alibaba, Baidu, and JD.com. Meanwhile, Howard Marks of Oaktree Capital not only boosted his stake in Alibaba, but also bought positions in Pinduoduo and NetEase. So what's the rationale behind these moves? Well, first, these few behemoth companies represent the backbone of China's tech-driven economy. Because China protects the competitive landscape from Western megacaps, these Chinese businesses over the past 10 years have grown into hugely important companies and serve a massive population. Alibaba dominates e-commerce and cloud computing. Baidu leads AI and search technology. JD.com is an e-commerce and logistics powerhouse. Pinduoduo is shaking up e-commerce with its group buying model, and NetEase is a leader in online gaming. These businesses are not just well established, they're essential to China's digital and economic infrastructure. However, as we know, Chinese tech stocks have faced significant headwinds over the past few years. Ongoing regulatory crackdowns, a slowing domestic economy, and geopolitical tensions with the US have all weighed heavily on valuations. Alibaba, for example, is down over 70% from its peak, while JD and Baidu have suffered similarly sharp declines. Yet, for value investors like Burry and Marks, This represents opportunity rather than risk. If we look back to Seeking Alpha, you can see that these stocks are now trading at deeply discounted multiples compared to their historical valuations. So it's making them very attractive from a value perspective. Also, while these valuation metrics are cycling through, this is a good time to quickly mention how handy Seeking Alpha Premium actually is. As you can see, you get the full suite of valuation metrics. You can analyze 10 years of financial data. You can look up earnings reports. You can get unlimited access to analysis articles, earnings results, and actually one brand new feature they've just implemented are virtual analyst reports, which is super helpful if you're just starting to look into a new stock and you don't want to be super overwhelmed. For example, here on JD, if I click on the report, I'll immediately get access to a short company description, details on their competitors, an explanation of the quant rating, as well as a list of strengths and challenges the company is facing. This is a brand new feature available to premium subscribers. And as I said before, as a part of their Black Friday sale, you can score $90 off Seeking Alpha annual premium, or you can just use my link to try it for 7 days free and just see if you like it. But yes, back on topic, valuation would definitely be a big factor behind Burry and Marks buying up the Chinese tech stocks. But of course, another possible driver is the Chinese government's recent pivot towards more market-friendly economic policies. After years of regulatory crackdowns, Beijing definitely appears to be easing up on its heavy-handed approach, right? And is now actively supporting their markets. Furthermore, China's push to stimulate its economy through fiscal measures such as infrastructure spending and consumer subsidies could indirectly benefit these tech giants over time as well. So for investors like Howard Marks, who specializes in distressed and undervalued assets, this could very well be a calculated bet on a turnaround, and for Michael Burry, it's likely a classic value play, capitalizing on fear and pessimism to secure high-quality assets at bargain prices. Of course, this bet isn't without risk. China's economic recovery remains uncertain. There's geopolitical tensions that could flare up at any time. But if Burry and Marks are correct, they stand to reap significant rewards as these companies regain their footing, as China regains its footing and returns to growth. Okay, moving on to the third theme of the 13Fs this time around, we have an interesting one. Not one I thought I'd be covering, to be honest, but this theme is the increased buying of Bitcoin ETFs by hedge funds. Big names like Millennium Management, Capula Management, and Tudor Investment have all been boosting their stakes in Bitcoin ETFs, signaling a renewed interest in digital assets among institutional investors. So what's driving this sudden surge? Well, first, the timing is quite significant. The US presidential election and its aftermath have caused a much more favorable backdrop for Bitcoin and other cryptocurrencies. Of course, Trump has stated he is going to be very crypto friendly, and the possibility of clearer regulatory frameworks and growing institutional acceptance of crypto as an asset class have added fuel to the fire. Bitcoin itself has been on an absolute tear. Prices, as we know, are rallying to new all-time highs recently, and these funds are clearly positioning themselves in the hope that that trend continues. And of course, one key factor here is the introduction, of those Bitcoin ETFs, which offer a simpler and more regulated way to gain exposure to Bitcoin without dealing with the complexities of holding the cryptocurrency directly. Hedge funds like Millennium have significantly increased their holdings in ETFs like the iShares Bitcoin Trust. For Millennium alone, their position doubled to over 23.5 million shares valued at nearly $850 million. Another reason hedge funds are likely piling in is, of course, the arbitrage opportunities these ETFs provide. In some cases, ETFs trade at premiums or discounts to the underlying asset, creating short-term profit opportunities for these sophisticated players. Hedge funds, which excel in exploiting market inefficiencies, are likely taking advantage of these opportunities while also betting on Bitcoin's long-term price appreciation. However, of course, it is worth noting again that this is not a risk-free investment. Bitcoin's volatility is, of course, legendary, and its future action is still highly, highly speculative. But for these hedge funds, the potential upside appears to outweigh the risks, hence adding substantial stakes in Q3. Okay, moving on to our fourth theme for Q3, and it was Mohnish Pabrai again doubling down on the metallurgical coal stocks. So while coal might not be the most glamorous or environmentally friendly industry, Pabrai's investments show that sometimes contrarian plays can present compelling investment opportunities. So over the last quarter, Pabrai significantly added to his holdings in companies like Alpha Metallurgical Resources, Consol Energy, and Warrior Met Coal. But Why is a highly regarded value investor doubling down on an industry that many believe is in terminal decline? Well, first it's important to understand the distinction between thermal coal and metallurgical coal. So thermal coal, used primarily for electricity generation, is rapidly being phased out as countries transition to renewable energy. But on the other hand, metallurgical coal is a critical ingredient in steel production, a process that currently lacks scalable, cost-effective alternatives. Even as the world transitions to greener technology, steel will obviously remain essential for construction, infrastructure, and manufacturing, and Pabrai is betting that the shift away from metallurgical coal will take decades, giving these companies plenty of time to generate substantial cash flows. And of course, one of the key attractions of these stocks is their valuations. Many of these companies are trading at extremely low PE ratios. For instance, Warrior Met Coal has a PE of just 9, Consol Energy is also at 9, and Alpha Metallurgical Resources at 8.5. So these low multiples suggest that the market is pricing in a steep decline in their future prospects. So for value investors like Pabrai, this represents an opportunity to acquire shares in a cash generating business at a bargain price. In addition to low valuations, these companies are also very shareholder friendly. Many of them are returning significant amounts of capital to investors through dividends and share buybacks. For example, Alpha Metallurgical Resources has been aggressively repurchasing shares across the last few years, which not only boosts the earnings per share, but it also increases the ownership stake of the remaining shareholders without them having to lift a finger. So that's the thesis on metallurgical coal stocks, and Mohnish continues to double down at low valuations. And finally, that brings us to the big news from the Q3 13F filings, and that was that Warren Buffett was not done selling Apple stock. We saw last quarter he reduced his holding by 50% to end the quarter on exactly 400 million shares. Now, a lot of us thought that was it. He also holds 400 million Coca-Cola shares. So we were kind of all convinced that he was doing the same thing, just holding 400 million shares as an ultra long-term investment while taking some profits today. And we were wrong. We were totally wrong. In Q3, he reduced the stake by another 25%, selling 100 million shares. The decoy, the devil, he definitely fooled me. So what on earth is the Oracle of Omaha doing here? Well, first, it's important to note that Buffett hasn't fallen out of love with Apple. He's still holding a very substantial position worth over $70 billion, making it Berkshire's largest single stock holding by a long way. And as I've said a lot on the channel recently, this move appears to be more about portfolio management and cash allocation than a loss of faith in the tech giant. Let's not forget, Apple's stock has been on a tear, climbing around 75% from the start of 2023. So this sharp rise has significantly increased its valuation, with its price to earnings ratio now sitting at a lofty 37 compared to the PE of 12, which is when Buffett first started buying the stock. So there's no doubt selling at these elevated levels has for sure allowed Berkshire to lock in very substantial profits at very high prices. But Warren has also taken the time to detail why he's liquidating his Apple stock to such an extent this year, and the simple explanation is that he wants to hold more cash. At the end of Q3, Berkshire was sitting on a record $325 billion of cash, and the Apple sale is certainly contributing massively to this. So why is this significant? Well, you don't hold cash for no reason, right? So I've spoken about this a lot lately, but it certainly does hint that Warren Buffett wants to shore up cash reserves to potentially take advantage of opportunities that may or may not be coming our way if there's sustained economic uncertainty. With inflationary pressures persisting, geopolitical risks still high, Trump in power, and the Federal Reserve beginning to shift monetary policy, who knows what comes next. So I think Buffett is pretty obviously positioning Berkshire defensively for whatever lies ahead. And, it's worth remembering that that's not a particularly punishing strategy at the moment. Remember, the 3-month T-bill is still at 4.5%, so not too bad. But overall, guys, with that said, they are the 5 biggest stories to come out of the 13Fs for Q3 of 2024. One more thing, if you're interested in learning the Warren Buffett approach of selecting stocks and you want a full guide on reading financial statements, valuation, and a whole lot more, be sure to check out Introduction to Stock Analysis over on New Money Education. And finally, a big thank you again to Seeking Alpha for sponsoring this video. Be sure to get your $90 off of Seeking Alpha Premium for Black Friday. But with that said, please like the video if you enjoyed it, and I'll talk to you all in the next one.